Over to you, Rushanara.
Thank you. I've got some questions about mortgage pricing and policy, and then government interventions, potential government intervention, and so on. So just a few quick follow-ups. Charles, to start off with you. You mentioned this number, pre-23rd of September, of 1,634 products, which went down dramatically to 864. Do you have any figures on how many people were affected during that period, roughly? I mean, like your son, for instance, who were unlucky. But certainly I'm aware of a number of my constituents and friends as well who were caught out just in that time, which was very unfortunate that we had a Prime Minister at that time who made the set of decisions which then meant their bad luck bad luck was intertwined with that period and those decisions at that time. Can somebody, would your organisation be able to do some analysis to tell us how many people were affected? Because up and down the country, we're getting input from our constituents in distress. Particularly, we have been, particularly during that period, and it would be really helpful to understand, what that cost impact was for them. We hear about overall, numbers. Some people have quoted, I think, 1,200 as the trust premium, according to one source. So is that something you can do, or you were able to hazard a guess on?
At the moment, we only have the information on mortgages that have been approved and actually drawn down. We don't have information on as we talked about earlier, in terms of those decisions in principle. But whether Chris would have any of that information, I'm not sure whether it would come from...
All I can observe is that volumes, new business volumes, so application volumes, are lower now than they were before, which we would attribute to higher rates and higher stress rates and general uncertainty. But it's hard to quantify the number of people.
And on we've talked already. You've been asked about first-time buyers and the rough estimate of 60% of mortgages for 95% loan-to-value clients who are predominantly first-time buyers. Do you have a sense of what the numbers are now? You mentioned, Chris, that the numbers were starting to go up for certain groups in terms of access to mortgages. Does anyone have a specific number to tell us precisely how many now is it? What percentage is it at? Did somebody mention 75%? I just wanted to be clear how many people, or what percentage of people are actually who are in that category of 95% loan to value, actually getting
volumes in 95%, and how many are getting. I can give you some precise data. I can't give you it off the top of my head.
Sure.
We would normally write between 3 and 5% of our business at 95%. Exactly what it is today, I couldn't tell you, but I'm more than happy to let the committee know.
Did you observe a shift during that period?
Not dramatically skewed to 95% versus everything else. It was a general slowdown.
Okay. Just back to Charles, do you have any specific figures on what's happened to those 95% loan to value customers or customers?
Not in front of me at the moment, no. And the figures that we collect from our lender firms are not up to date enough. We don't collect them that frequently to be able to provide you information over the course of the last 3 weeks, I'm afraid.
Would you be able to share something with us at some point?
Over time, yes, but it would be several weeks away before we get that information collected from lenders, because they don't send their information through to us on a real-time basis.
Sure,
we can certainly provide that to the committee.
I think it'd still be very useful for us to understand, even if it's a few weeks down the line, just to see what sort of intervention, what sort of assistance, or what then the response should be. Ray and Joanna, did you want to comment on any of these points about first-time buyers?
Not for me, thanks.
Well, I think the key thing from a broker perspective is that there is a reasonable choice, and although that choice is not as high as it was a couple of months ago, there is still a reasonable choice. But it's not.
What does reasonable choice mean? I mean, if it's a switch, if it's a difference of 2%, is that reasonable in your view?
Well, as Charles mentioned, there's about 80 products on the market. Now, of course, not all of those will available to any one customer. Not all will be right for any one customer. But Ideally, you want most of the major lenders in that market, because last year the top 6 lenders did 71% of lending. So if you've got all top 6 in the market, then that straight away makes a huge difference. Yeah. But with some of the smaller building societies, because their underwriting is manual, they can be really useful for first-time buyers who very often may not have a particularly high credit score, perhaps because they haven't had any credit before, but actually they're a perfectly good credit risk. So from a broker perspective, one of the key things we have to identify is which type of lender is that client going to be most suitable? Can they go to any lender, or do we need a lender that uses manual underwriting?
Okay, and could I don't know who would want to come in, but to what extent might the credit risk component of mortgage rates need to increase to compensate for any expected increase in defaults and arrears over the coming years? Who would like to come in? Maybe it's one for Chris.
So, as you go through the economic cycle, and actually Ray highlighted it before, in recent times the differential between low loan to value and high loan to value has become much, much smaller as largely competition has stepped up and risk has become lower. As you face into the environment we're now facing into, and we have not done anything yet, but you ultimately have to look at the risk-reward equation in terms of what you think might happen in the future, and that could cause those prices to go back out. That's not a forecast or a definite, but we certainly look at the overall risk profile, particularly and therefore the pricing for each of those segments.
And given that yields have fallen from their recent highs, assuming those falls in gilt yields are sustained, how quickly and by how much might mortgage rates fall back?
So, like I say, we've already, for existing members, priced below 5%. We're reviewing what we now need to do for, if you like, new to Nationwide business.
And are you seeing, in terms of, I don't know if you're willing to comment on the market more generally, are you seeing a similar sort of response?
If I can pick that one up for Chris. So from the point of view of what we're seeing in the market, all lenders are coming back into the market with lower rates at the moment. The vast majority of lenders are coming back into the market with reduced rates at the moment to reflect the cost of the funds that they're having to price when they're doing their fixed rate mortgages.
Are there any that aren't doing that?
I couldn't tell you which. With 150 lenders, we don't monitor them all on an individual basis. But we monitor the market. We're very
interested in knowing who is passing it on and who isn't.
In terms of when they're passing those on, it is in terms of the cost of the funds to them and how much it's charging them. Lenders, it's a very, very competitive market in terms of the mortgage market. Lenders want to lend, and they want to ensure that in terms of they're getting
I'm not sort of doubting the competitiveness and all of that, but I'm conscious that obviously the market's experienced a lot of turbulence in that month, so one can understand, the risk aversion that lenders might face at this point as well, and whether that then means that some of them, depending on their size and internal issues, might make them more reticent than they were before. I just wondered if you've got a sense of any of that coming through.
Well, lenders will assess every application on its merits and in terms of individually. For a lender, as I said before, it's not in their interest to lend to somebody that can't afford the mortgage. And in terms of going to a mortgage broker, you're getting that choice in terms of where the best rates are for you and your individual circumstances. And we're very supportive and encouraging of borrowers to
there were people
get the whole
who could afford
advice.
Mortgages before mortgage rates went up because of the mini budget fiasco. So anyway,
I am disappointed at the slow speed with which rates have come down, frankly. So to be fair, when rates went up, we had a few days' grace. I mean, Halifax was one of the last lenders to put their rates up. So it was clear what was going to happen, and brokers had best part of a week, I would say, with some lenders to actually get applications in at the old rate. But now rates are falling. Lots of the reductions are relatively small, 20 basis points, and we're consistently seen gilts fall, with the 2-year gilt now down to about 3%. So I do believe there is scope for rates to fall further. But
why do you think they're not doing it? Why do you think they're not being as fast at reducing them as they were at increasing them?
I'd be interested in Charles' comment on this, but the impression we get is one of the issues is that lenders don't want to cut rates too quickly because they're worried about then getting too many applications in and not being able to meet their service standards. So it's always a balance between offering a rate that is competitive, but not a rate that's so competitive that you then see your service standards fall over.
Unless they,
by the way,
the
Bank of England is meeting, the Monetary Policy Committee is meeting tomorrow, when there's, by all accounts, almost certainly going to put rates up. So
yes, as you said, Chris, that may or may not change in terms of the lenders will be waiting to see where the bank puts the base rate.
Except my questions are about pricing, and yes, obviously all the banks have had some line of sight of what's happening with bank rates, which have been consistently going up. But my questions were about the September period and what's been happening to rates and the cost of borrowing, and of course within that context there's the bank rate increases and so on. So I'm kind of just to pursue this point, which is, your point about competitiveness for a lower rate, if they don't all act together, that presumably makes it more difficult, less likely for rates to go down as quickly as they went up. Just to pursue that point.
Lenders can't get together if
no,
they're all worried about service standards.
I appreciate that. What I'm saying is that if there's an individual outlier that's lower, as you were saying, then there'll be too much demand for that particular rate.
Yeah, I suspect what we'll see is, providing gilts maintain their current level, and depending on what happens tomorrow, and what the Bank of England says in terms of the future, that clearly could have a big impact. But if gilts do maintain their current level, then I do think there is scope for the cost of fixed rate mortgages to steadily fall. But that trend will take several weeks to get to what in my view would be the right level.
Okay.
Which I agree with, that we are trying to manage volatility and don't want to get caught out by volatility that we can't see. But maybe a bit of context. So the 2-year swap, which would determine the pricing of 2-year fixed rates, on the 20th of September was 4.34. It drifted up ahead of the budget. It was 4.60 on the 22nd. It peaked at 5.85 on the Tuesday. Was back to 5.39 by the 30th of September, and the last data point I've got here is 4.6 on the 24th of October. So we have seen a huge degree of volatility that we're managing. From my point of view, I've got 285 billion balance sheet, 180 billion mortgage portfolio that we need to manage the interest rate risk on. So we are very thoughtful about managing that volatility.
Well, so before you were managing bank rates, and then since September you've been managing a whole load of other volatility, right? Did you foresee that you'd have to deal with a set of issues that causing volatility that's linked to the mini budget? Did you? I know lots of people were taken by surprise, but is that something you factored in? Those sorts of changes.
Clearly, we would have had no idea what was in the mini budget, or indeed what the market reaction would be, and we shouldn't have, bearing in mind the sensitivity of.
Oh no, I'm not saying officially, but in terms of, just as we were all looking at announcements or directions of travel. During the summer leadership contest, is that something? Did anyone kind of have a sense that there could be volatility? You found yourself having to respond to the volatility.
We didn't know what was going to be done, therefore what the consequences would be.
Okay. Joanna, did you want to speak to some of the, any experiences that you've come across in terms of what the impact has been that you've seen from your organisation?
Yeah, I think
whether you've got data as well.
Yeah, so we're a debt advice charity. So typically people take a while before they come to us. And it's a brave decision when people do decide to tackle their debts, but that takes them a little while. So there's always a lag. So the quick answer is no, I haven't got data I can share with you on that. But I think what we can say is that people are very worried. We talked about that sort of perfect storm. And I think when you bear in mind, it's what was it, 2008, the last time mortgage rates were at 6%. There's a whole cadre of people in that 14, 15 years who've only experienced very low interest rates and have no idea. I mean, some of us can remember mortgage rates of 15% a very long time ago, but that this new set of people haven't, just have not had that experience. And I think that puts an onus on all of us to explain to people and to make sure that they're thinking ahead. And some of the banks are good at this, and there's stuff on websites about case studies and things to watch out for and all that. And others perhaps not so. I think there's a job for all of us to do in looking ahead and saying it's not going to be easy. We all know that. What is it we can do together to protect people and support them and ready them for those challenges?
But the reality is we've had a decade of wage freezes. The value of properties, especially in the southeast, London, the southeast, and so on, the cost of mortgage, the size of mortgages are much higher than they were back then. So we're looking at, some people have said, well, mortgage rates were that level before, we can get back to that sort of level, but not taking into account the wider context that you talked about earlier as well, in terms of cost of living crisis and so on.
I suspect when the FCA was designing the stress testing, they were not thinking that alongside the increases we've seen here, you'd be looking at those massive energy increases at food inflation at 11% and so on. So it is a perfect storm, I'm afraid.
So speaking of perfect storm, that sort of takes me neatly on to what, if anything, government can or should and ought to do and so on. There are various numbers that been floated around. The Resolution Foundation estimated some time ago, actually, around the average mortgage London household will be paying $5,500 more in annual costs by the end of 2024. A more recent figure in a piece in an article in the Mirror newspaper says families face an average of mortgage hikes of $6,700 a year. So we're talking about the thousands, depending on which analysis you go for, but the latest ones are in that sort of territory. And you mentioned somebody mentioned £200 a month in addition. So what do you think, during the pandemic, for instance, the FCA introduced a number of support measures for mortgage holders, including encouraging lenders to offer mortgage holidays. Now, I personally don't think that mortgage holidays are necessarily the answer, because in effect the mortgage holder is paying for Liz Trust's mistakes, frankly, in the mini budget, and they shouldn't, and they'll have to pay interest on it. But are there ways in which government should be looking at taking the edge off for a period of time until the economy gets back into a better footing, which could be some years, and that we prevent repossessions or distress in the different markets that we're talking about, first-time buyers, existing households, and the buy-to-let sector, where, given the pressures on the knock-on effect in terms of pressures on rental properties. What are your thoughts for each of you on some of these points? What might be good interventions that government should and could be considering?
It's heartening to hear what you're saying about the no return to the payment deferral scheme. That is something that the circumstances when it was introduced during the pandemic are very different than they are today.
Yeah, well, pandemic wasn't no one. It wasn't anyone's fault per se. This is very clearly the fault of a particular government at a particular time.
In terms of what the tools that lenders have available at the moment, they have a range of tools that they have been using for a number of years, certainly since the pandemic. They've got issues for things like if anyone's facing financial difficulty, then in terms of there's opportunities to move to part and part, which is part interest only, part capital and repayment, to move to interest only for a period. to have an extension in terms of the mortgage term to help with affordability.
Would that still mean that the actual mortgage holder ends up paying a certain amount, or will the government guarantee? Do you think the government should guarantee that in some way?
In terms of an extension term or moving to interest only, yes, the borrower will be paying a little bit more over the lifetime of the mortgage. But in terms of things that that we'll be looking for the government for, we've already asked the government in terms of to review the support for mortgage interest scheme to enable homeowners who are in financial difficulty to get access to the support for that sooner rather than it is at the moment, and also to remove the zero earnings rule. Also, in terms of, I mentioned earlier, the reintroduction of the mortgage guarantee scheme for higher loan-to-value lending would be very important, very helpful. But also in terms of to link perhaps housing allowance and housing benefits to inflation as well, to ensure that maintains pace with inflation and reflects the cost of living challenges that all homeowners and also in terms of tenants are facing. So it's a range of issues that we believe that we would like to see the government work to support homeowners and tenants to afford the homes that they live in.
Did anyone else want to come in?
Can I come in on that? So just to agree with Charles in terms of what lenders already are offering, and most of those are required by the FCA, I think, those measures. And just to come in on, if I may, on support for mortgage interest. So you might remember that this was something that used to be a grant and is now a loan. So the numbers of people accessing it have fallen very dramatically. I think there's now something like 12,000 people a year using it, so that's pretty small. Given it is a loan, I think the government could do much more, and we and UK Finance and the building societies and pretty much all the charities have called for the government to act here. And the two key areas they could act, one is you have to wait 9 months for that. That is a very long time. You are going to have exhausted your lender's patience and probably all your own resources by then. So that would be the first one. And secondly, you cannot earn a penny. You cannot earn any money at all and still be able to access support for mortgage interest. Now, when the current Prime Minister was Chancellor, back in June this year, he signed off those changes. We haven't heard anything from him since. We certainly are urging him to come back to that, and the need is greater, as we've all been saying, than it was back in June. It would be wonderful if the committee were able to support that as well. But that would be our key ask of government at this point.
Okay, thank you. Well, if you've got anything else that you can send in writing, that would be really helpful. Just one final question for Chris and Ray, which is how many people do you think are at risk of repossession? And is there a case for government providing, what would the market be looking for in terms of government guarantees and support that doesn't, as I say, doesn't punish the mortgage holder for Prime Minister Liz Truss's mistakes, but at the same time enables the market to function effectively and people not to face repossession or distress?
Can I come in on
the
repossessions point whilst Chris and Ray are thinking about that? One of the benefits of the stress test that was referred to earlier in terms of the mortgage affordability has been to ensure that homeowners, when they're buying a property with a mortgage, can afford the any additional costs that may come through over the lifetime of that mortgage and beyond. We monitor and we track the level of arrears coming through. We report on that quarterly. We're just about to put our latest quarterly review out into the market. The indications are that arrears are extremely low at the moment, much lower than we have seen for
but it hasn't, with respect, it hasn't come into effect yet because people's rates are currently fixed that are going to come up for renewal, and we can see that in the data. So what I'd be interested in knowing is what the sector needs going forward, what the government can do. So right now, but in 2 years' time, that's not going to be the case over the next 2 years. I know that. We know that from what our constituents are telling us.
In terms of the support, I think Joanna and Charles have covered it. I think it's worth remembering that the tools that have been described that will be used on forbearance compared to financial crisis, and particularly certainly those who have been around a long time, the early 1990s, will result in a much lower level of repossessions than was the case in previous cycles. So, if someone is engaging and paying something, they are unlikely to get repossessed at all. It might be in their best interest to do so if they can never afford the property they've got. But I think repossessions compared to previous cycles will end up being materially lower because of the tools that have been deployed through forbearance that have been mentioned.
Right. Well, just to add to that, I mean, as Chris says, the key thing from a borrower's perspective is they must engage with their lender, because providing they are demonstrating that they are paying what they can afford, then I think in many cases lenders are going to be very reluctant to go to repossession, and even if they did, the court probably wouldn't agree to it. So that's the key thing, engage. And the other important thing, which is different to some of the previous downturns, is that because we've had such a big increase in house prices over the last 2 or 3 years, even if we get a 10 or 15% fall in prices that I expect, most people are still going to have equity in their property, because that will still take prices back to a level higher than at the beginning of COVID. So if you can see that you are going to have a problem when you come to the end of your fixed rate and you will not be able to afford the higher rate, then you've actually got some time to think about it, and much better than being repossessed if you really can't afford. Sell the property yourself means you're in control, you can maintain your credit record, but if you get repossessed, you will not be able to buy another property in all probability for 3 to 6 years. So I think that is one of the key things. People in the main have got equity. Obviously we know there's exceptions, people with cladding problems, etc., but most people should not need to be repossessed.
Thank you.
Could I just add one thing to that, which I agree with all of that. I think repossessions are low and hopefully will stay low. I think we always, at National Debt Line and Business Debt Line, we always urge people to talk to their lender. That's the best thing to do. But I think we should acknowledge that that's a scary thing to do, particularly if you think you might lose your home. And so there is this, we mentioned this point before about this kind of asymmetry of power. I think there's something about us working together. If some of us got long memories going back to the credit crunch, there was an information campaign that the government ran in conjunction with lenders and charities, and that was about, the tone of it was, don't be scared, there are lots of people in the position you're in, this is where you can seek help. And I think we are going to need something like that over the next while, because otherwise people will bury their head in the sand just because it's a very scary thing. They're juggling all these different price rises, and giving them a simple message that they're not on their own. Lots of people are experiencing this. This is where you can get help. Talk to your lender. Seems a good message for governments.
Well, let's hope the lenders listen. Thank you.
Thank you very much.
Can I just add to that? I think that's a really key point, and a lot of borrowers may well find it much less scary to talk to their broker than the lender. So the lenders will say, talk to us, and that's fine. But actually, if you have a problem with that, talk to your broker, because the broker may actually have some alternative solutions with different lenders, perhaps. So perhaps the message should be, talk to your broker or your lender, not just talk to your lender.
Okay. Thank you so much.
Everyone's jostling for attention here, but I'm going to ask Gareth to come in now.